Have you ever been in this situation? The price surges sharply, you're afraid to miss the move, you jump in to buy.
A few moments later.
The price collapses like a waterfall. The next time, you try to be patient and wait for a retracement, but it never comes back. That's the tragedy most traders face, not knowing whether a pullback is real or just a trap. But trust me, once you understand the nature of these retracements, you'll stop letting the market's every sneeze wipe out your account. A pullback is how the market breathes. And if you can catch that rhythm, you'll enter trades alongside smart money instead of being devoured by it. A pullback is a temporary move against the main trend before the price resumes in its original direction. It's not a reversal, it's the market's way of gathering momentum. What's fascinating is that there are 4 common types of pullbacks that professional traders always watch for. Each type has its own story, its own entry method, and if you understand them, you'll know exactly when to pull the trigger. The first type is the blind pullback, also known as a no confirmation entry. This is a bold, high-risk but powerful approach. You don't wait for any confirmation. You simply rely on key price zones areas where the market reacted strongly before. When price returns to those zones, you act immediately. For example, gold is in a strong uptrend. There's no candlestick pattern, no clear signal, just a quick touch of a key level and a long lower wick rejecting it. If your analysis is correct, the reward to risk ratio could be 3.1 or higher. This kind of pullback is like sniping through the fog, not for the faint of heart, but for those who truly understand market structure. It's a rare and valuable opportunity. The second type is the pullback confirmed by price action. This is the most common approach among disciplined traders. They never enter just because the price hits support, they wait for a clear confirmation. A pin bar rejection, a strong engulfing candle, or even a fakey pattern that traps weak hands before reversing for real. For instance, on the USD H4 chart, after a strong rally, price retraces to support and forms a bullish engulfing candle right at that zone. That's a signal that buyers have stepped back in. The trader goes long, placing a stop below the nearest swing low. When the price surges again, you know you didn't just catch a clean entry, you caught the move alongside real institutional flow. The third type is the pullback to the EMA line, a return to the mean. Price never moves in a straight line. It oscillates around a balance point, and the EMA 20 or EMA 50 often represents that equilibrium. In an uptrend, price typically dips back to the EMA before continuing higher. In a downtrend, it rallies to the EMA before falling again. This is a dynamic pullback. Not fixed like support or resistance, it moves with the market's behavior. For example, GBP/JPY is trending strongly on the H1 timeframe. After a sharp rally, price retraces to touch the EMA 20 and forms a bullish pin bar. Price then bounces sharply as the EMA continues sloping upward, confirming that the trend remains strong. This is a favorite setup among institutional traders because it's simple, clean, and reliable. Finally, we have the Fibonacci pullback, typically between the 50% and 61.8% retracement levels of the previous impulse move. This is the golden zone, where large funds often accumulate positions, as it offers an ideal risk-to-reward balance. When price revisits this zone and forms a confirmation candle, that's your cue to act. For example, on XAU/USD M30, price rallies upward. When you plot the Fibonacci tool, the 50%, 61.8% zone becomes clear. Price retraces precisely to that area, forming a long-tailed bullish pin bar that rejects the level strongly. All that's left is to wait for confirmation and enter at the Fibonacci support. Traders who understand Fibonacci know this is where the market inhales before making its next explosive move. A pullback isn't a reversal. It's a necessary pause that allows the market to regain strength. Ordinary traders fear these pauses, but professional traders wait for them. Once you grasp this concept, you'll stop chasing the market and start letting it come back to you. Patience, discipline, and timing. That's the mindset of a true sniper trader. If you found this content valuable, don't forget to like the video, subscribe to Zeus Trading Cashback, and join our Telegram group in the description to receive real-time gold and forex trading strategies and signals. Remember, trading isn't a game of luck, It's a game of rhythm. Only those who understand the pullback can jump perfectly into the flow of profit.